Welcome to another What's Up with the market status update. Haven't done one for a while. I've been away. Apologies. Was going to do one last week, but a bad cold got the better of me. But we're here today, and what a day. We're going to have a look at the charts, see what the international indices are doing, and also what some of the commodities are doing as well. There's been some movements, and we're going to focus today on a couple of the charts that we've been talking about. I've been talking about a little bit, but they've come to the fore and they're going to be the story of the day. But before we do that, just a reminder that none of this analysis is used in SPA3 Investor or SPA3 Trader that I'm doing here. This is generic technical analysis of the markets, just using a handful of techniques that I've grown to become accustomed to and use. And I find that gives a subjective view of what's happening in the markets and what's happening with technical analysis of charts. So none of this analysis is also used to make any decisions in the public portfolios. They are purely 100% mechanical, following a mechanical system. And I use none of this analysis in my own personal portfolios. Either whatever analysis comes out of here and whatever themes or messages that come out of here don't affect the decision making that I have in my own personal portfolios either. I'm a mechanical trader and precisely follow our systems, that's buy and sell, but also the risk and money management rules that are part of the systems as well. And before we do it, before we get into it, I have to tell you that everything we cover here today with up-to-date daily prices is that everything we cover is generic investment advice or general investment advice. There's no personal or direct investment advice here. Right, into the charts. We are going to start off, as we always do, with the Dow Jones. And what a breakout that is. That is just stands out like a breakout should. We're in the up channel over here. We have had a bit of sideways movement, a bit of a broad range trading market in the Dow Jones, made up of 30 constituents. And you can see down bottom right here that has been underperforming the S&P 500, but a little kick up over here. And you can see I've got a moving average on there. That's, what is it, an 89-day moving average. And that's the green line, been sloping down. It's only a couple of bars in there, but still significant in that there is a bit of a change going on where the S&P 500 and NASDAQ have been performing. So let's have a look at the S&P 500. You can see it doesn't have that breakout bar like we've just seen. I'll just zoom in a bit here. Like we've just seen in the Dow, broader market, and also some tech stocks in there as well. And more stocks. So one or two big moves, and health was a big move. United Health was a big mover in the Dow Jones. Had a bigger effect on the overall index than having 500 stocks, which kind of waters down one big move in a single stock. But the volatility is low here on the S&P 500, while it's below that 1% level, which is that red line. There's another red line above that, which is not showing, which is 3.5%. But volatility is low, indicative of a bull market. There is the all-time high down here. I'll just go back to the Dow Jones, and you can see just by naked that the S&P 500 is much higher above its previous all-time high than what the Dow Jones is. So this is an uptrend. We are still, I redrew this channel, as I said in the last session, just to take into consideration the way that this chart was forming. And you can see that we're in the lower half of this channel. So there's upside in that channel. Now, remember, that's a subjective drawing of a channel, and you could come up with variations there, but you would have maybe slightly different gradients, but it would show much the same thing. Onto some breadth of market indicators. What we look for here is divergence. There's no divergence here. We've got the new high, new lows, 52-week high lows, that is rising. So more new 52-week highs than what there are lows. And it's rising, and the index is rising. The blue line's the S&P 500. So that's all doing what it should do. Looking at the the advanced decline line, and there was a bit of divergence here. Look at that trend line, and the blue one I've got over here going in opposite directions, showing at that particular time there were more stocks falling than rising. And whereas now that's back on track again. So no warning signs there on that breadth of market indicator. The number of stocks above their 150-day simple moving average. There was divergence there, and those are the two. I just line them up. I try and get the exact same bars here. And what we've seen now is that divergence is corrected, if you like, and we've got the number of stocks above their 150-day moving average rising, as is the index rising. So no early warning signs there. The US dollar, we've got this behaving as well. We've got a risk on. There's the indication I've got here when that SIROC, when that smooth rate of change indicator is declining. We have the stocks outperforming the US dollar, and what we want is a falling US dollar and a rising market is a positive thing for equities. So that's all going in the right direction as well. Right, looking at growth versus value stocks. Just I've put trend lines. This is the Russell Value Index. This is the Russell Growth Index, and above the all-time high over there, we've got the trending indicator here, which is the SIROC of the relative strength line. So that's a ratio between the two indices, growth and value. See, value just popped up here in the last couple of days, but the trend is certainly showing that growth is outperforming value. That's also risk on. That's a good thing. For rising markets, that is. Consumer discretionary versus consumer staples. Staples, bottom right here. You can see there's the trend line going down, just sideways to slightly down. And we've got discretionary rising. And we've now had this ratio line that started rising again. You can see the green, the moving average on the ratio line, relative strength line. And we've now got the indicator of the relative strength line also just given a risk on. So all things are aligned so far. This one is not aligned. This is the put-call ratio on the S&P 500 of the equities, the stocks. And you can see that that was rising. So when that's rising, that means there are more puts than calls on. That started falling. I'm just looking at the lows. You could also draw a trend line on the peaks over here. So it's starting to trend down, meaning that calls are starting to come back into fashion or outweigh puts, if you like. And but this indicator it hasn't turned yet, so that's an indicator of the 252-day simple moving average of the put-call ratio. It's a bit of a long one. If I made that less than a 252 a day, then this indicator would be a bit more sensitive. But still, we're seeing the lower lows and lower highs over here, and we should see that also turn. It's a bit of a slower indicator there. We want some confirmation, but hasn't given us the green vertical line yet. Keep an eye on that in coming weeks. Yields on the 10-year Treasury note falling. You can see the downward channel, lower highs, lower lows here. And if yields do come down, and there are some words that are being said by Treasury, by the Fed in the US, then we'll see a fallout below the bottom channel line over here. But certainly the ratio of Treasury yields to stocks, that's the ratio there, is showing risk on. So stocks rising, yields falling, that's also a good thing. And that in fact, I should say at this stage, is that this is playing a big role, and certainly the words are, and the projections that are coming out of the Fed, but we've got to see it follow through in actual yields. On the chart here, is playing a big role in what I'm going to show you with mid and small caps in a moment. Okay, and the opposite of the yield are the bond prices, and what we want to see is because yields fall, bond prices rise. We want to see bond prices and stocks go in the same direction. They won't go at the same rate, but certainly want to get the same direction, and that's happening as well. Certainly it looks like stocks are going up by more than bond prices here, but just looking at the lows, that it's certainly not the peaks are, but the lows are getting higher in bond prices. So that's also behaving. The VIX index is down at pretty low levels. Just zoom out over here and you can see where they are. So historically and relatively low as well. Also a good thing for risk on in stocks in the US. The NASDAQ composite index, there we've got the relative strength line. Now that relative strength line is between the NASDAQ and S&P 500. So that's stocks versus stocks, but a certain kind of stock versus another kind of stock. And what we're looking for here in a risk-on environment is the NASDAQ outperforms the S&P 500, which indeed it is. And you can see the relative strength line there. Obviously not the relative strength. The blue line is not a straight line. It has little ups and downs. But you can see that the moving average, the green line, is trending up. And we do have the indicator. The indicator is also rising as well. But notice that the bar, like the S&P 500, the most recent bar, was certainly not shooting the lights out like it was on the Dow Jones and like we're going to see in a moment. So there's a little bit of rotation that's going on over here. Obviously, the large cap tech stocks have been shooting the lights out, and you would have seen that they weren't shooting the lights out overnight relative to some of the other stock movements. The NASDAQ 100 of the 2,200 odd NASDAQ composite So about what is that, 5% of the stocks, and large cap stocks also rising, but certainly not as much. A little bit of stalling happening over here. And this here is also a relative strength line between NASDAQ 100 and S&P 500. And what we're looking for, for a raging bull market is for NASDAQ 100 and NASDAQ Composite to outperform the S&P 500, which has been happening over the last couple of months, well above all-time high. Let's just go back up to the NASDAQ 100. There's the all-time high, the black rectangle over here. So trending up and above and in this upper channel line. Now, one thing I did do, it came out of the last session, is that I've now changed the NASDAQ Composite to a semi-log chart, and also have redrawn the trend lines. So that's showing it still in the upper channel. The previous without log chart, it was bumping its head or getting slightly above the upper channel line. So I corrected that. And the same with this chart, is also a log chart, is just in the upper channel line as well. So subjectively, and saying how much room has this got to go, one of the indications, not the all binding one, is looking at the channel line. There's definitely upside in this market, available in this market. So it is certainly not, the whole market is not getting toppy and about to fall over. There are no indications of that. That's not to say it won't happen, but remember, these indicators all slightly lag because the data has to come in and the market has to do the moving for us to look at the indicators and put that into context of what's gone before. That's what a trend is. And that's what we're looking for. We're looking for trends. Okay, looking at the cumulative 52-week new highs versus new lows. A little bit of divergence here. This is on the NASDAQ 100. There's the indicator, the index rising. And here we can see that there are not, it's not certainly shooting the lights out in terms of number of new 52-week highs in the NASDAQ 100. The cumulative advanced decline line it's actually gaining over here. So we can see that there's more stocks that are rising than falling in the NASDAQ 100, and certainly a lot more strength in this here now. And that might be some of the smaller, the lower end of the 100 by market cap that are starting to make their play. Above the 150-day moving average, you can see that's rocketed up. So there was divergence here, a couple of divergence periods over here, but now the number of stocks that have shot above their 150-day moving average in the NASDAQ 100 has shot up. So that divergence is null and void now. We're now into looking at new analysis and seeing how the indicator goes relative to the number of stocks above the 150-day moving average. That's a breadth of market indicator. So the breadth of market indicators, the sentiment indicators are all lining up. This is a positive for equities at this stage. Now, let me just talk about this chart, and then we'll just give a little bit of a summary. This is the semiconductor index. It's a sector, and what we're looking for here, we're comparing it to the NASDAQ 100 to see which of the more risky, if you like, stocks are doing relative to the risky but less risky. But the NASDAQ 100 seem to be more risky than the S&P 500. So the riskier of the riskiest, if you like. And if this is rising, that's a good thing, because that's people are prepared to take risk in stocks that are typically more volatile. It's certainly rising in an uptrend. There's no doubt about it, but not. Look at the latest bar. It doesn't look like what the Dow Jones bar looked like, and looks more similar to the NASDAQ 100, NASDAQ Composite, and S&P 500, but rising nonetheless, and also still outperforming the NASDAQ 100 over here. So that's still a good thing. It's not a negative sign. It's not saying, hey, the market's going to fall in a heap here. It's just saying that there's some rotation happening. There's different parts of the market that are now getting their turn, and we'll have a look at which ones those are in a moment. So the All Ords has made a new all-time high, a couple of bars in a row, and you can see how that stands out, but still underperforming the S&P 500 all this time, still underperforming the S&P 500. That's what this blue line's telling us. Trend still down in terms of underperformance relative to the S&P 500, and that's just purely on a bar by bar, if you like, unit by unit point of view. That doesn't take into consideration exchange rate. Now, breakout nonetheless, clear breakout, 3 big green bars. And that's a breakout, a little bit inside day, some indecision coming out of the US, but that should be another update today, given what's happened in the United States. The Aussie currency still in a long-term downtrend and probably a short to medium-term uptrend over here. So a little bit more strength against the US dollar. Just quickly, the Nikkei, that black horizontal line is the previous all-time high, fell back into the range, has had another strong breakout to a new all-time high just a couple of trading sessions ago. Outperformance of the S&P 500 after some underperformance. And the DAX is hit some resistance. It had a really good, it was one of the first to break out of the international markets above its previous all-time high. Strong trend, consolidation sideways, still higher lows over here. And that there would now be a peak. I'll just put a 3-day swing chart on that, and you'll see that a peak hasn't formed yet. So there's still higher highs and higher lows happening in the short term, but not yet above that all-time high over there as the Dow Jones has just done. The FTSE made a break. It's very close to its all-time high. Now this all-time high is one. So there's the 2000 peak over there, and it's not that far above its 2000 peak and 2013 peak. So a long way behind the other international markets. And the last one we'll look at is the Bovespa. There's the previous peak over there, got above. That's the GFC peak, if you like, and the 2000, 2008, 2013 peak, and has really struggled, but I think it's given an entry signal on SPA 3. Yes, it has. Why do we look at this? Indicative of developing markets. So some strength coming in there, but still underperforming. It's just slightly starting to outperform the S&P 500. So we'll keep an eye on this as a developing market, because this is the next stage after the one that we're going to look at right now, which is the small caps. So to look at small caps and medium and mid caps, how they're doing, the first chart we go to is the S&P 500 equal weighted index, because that weight's obviously the largest cap, the same as the smallest cap in the S&P 500 index. And there has been a clear. So there's the previous all-time high. That's not going back to that's 2021. Sorry, let's just go back here. So that's just what I was going to say. I won't get into that. I'll just confuse things. But this is the high that was made 2 years or 3 years ago, nearly 3 years. Coming up for years? 2.5, 3 years ago. Not quite 3 years ago, 2.5 years ago. That was January 2022, December 2021. But this is what we're looking at here, is this movement above that. So slightly got above, consolidated, went sideways, and now a clear breakout. So compare that to what you got in your mind's eye with the S&P 500, and this equal weighted index has really jumped in this last couple of bars, last 3 bars, 1, 2, 3, maybe 3 of the last 4, and that's the lower end of the S&P 500 starting to jump. This is the mid cap, the S&P 400. So this is the next 400 stocks in market cap below the S&P 500, and that's its all-time high there. Now we can see that it's broken above it. What is that? That was also November 2021. So 3 3/4 years ago, struggling. It did get above, and now look how strong those bars are. 1, 2, 3, 4 in a row. Now that is really the next level of stocks below the S&P 500 starting to come into play. Been kind of matching, underperforming. Now just jumped up, but we still have. If you compare S&P 400 to S&P 500, that's what this relative strength line is over here. This outperformance is only just starting. We need to see this follow through. But of course, a follow through can't happen if it doesn't start. So now it started. And the S&P 600, even stronger. We've had really big moves, 4 in a row. And there is its all-time high there. That dotted black line over there, that also goes back to November 2021. So some real strength coming. It hasn't been enough yet, because there's a bit of a lag over here. We need to see some more proof of this price action that we haven't seen the risk on come through in the Ciroc yet, which is good, because what that does is smooth it. We don't want to be knee-jerk reacting to this stuff, but now we need to see this follow through to see this rotation, if you like, from potentially large cap tech stocks into mid and small cap stocks continue for some time, because that really is breadth of market. And then if we've got all sectors of the market moving and rising, that becomes a raging bull market. Now, raging bull markets don't last forever, but when they do happen, we really do need to be in them. We don't want to be sitting on the sidelines. This is our time in the sun. It might go a month, might go 2, 3, 4, 5, 6. We don't know, but we don't want to be sure. The evidence is there and has been there for some time. What we didn't know is whether the mid and small caps would come and join the party. And how long have we been talking about that for a number of months now? And now it's happening. This is it. This is the time. And now we have to act. We have to put aside the doubt and the distrust and the fear. And we have to, this is our time to make money. If we are active in the market, then we have to be active in the market. And so some of you might have some decisions that you need to make. Of course, it's happening in the US market. We don't know if it's going to pull through into the Australian market yet because the makeup of the markets are different. And that's been one of the primary differences between the two over the last few months, even last couple of years. And we know that's filtered through into our portfolios as well. Those of you who are trading both have seen really good returns in your US-facing portfolios, SPI investor portfolios, where it's been tough on the Australian market. Now, hopefully the Australian market gets stronger and better and we get that flow through as well, but we don't know if that's going to happen. So those of you who've been in the US market, have enjoyed your return so far. So the point is, if you're in neither, then now's the time to take some risk, even if it's with a small amount of money that, if you're still unsure and you don't have the process, you don't yet have the mindset, go and do the training, go and do the 4-week training intensive. It really will bolster your understanding and awareness when you actually do the training. But of course, you have to follow through and do the series of events, do the practice, do the actual execution. And this is the time to be doing it. This will be the time that has the least negative effect, if you like, on your psychology, if you're still getting that right. Okay, on to quickly doing commodities. Gold's the other one. Been going sideways, consolidating. There's the breakout above its all-time high, which happened in the beginning of March this year. Strong uptrend, consolidation, a rectangle, if you like, absolute classic technical analysis, new breakout. This is all pointing towards gold going higher. Whatever the reasons are, we can look for, if you look for reasons, typically people look for reasons to see, if the reason is going to fall down and therefore the price is going to fall down. Now, whatever the reason is, this gold is going. This is a new clear breakout. A couple of, just a short period over here of showing gold outperforming equities. But this is classic breakout, consolidation, new breakout. So gold should go higher. Silver still hasn't got to its all-time highs up over there, which is the equivalent, but starting to catch up and hasn't had the breakout. The price is not as strong as silver. I think the SLV ETF is an open trade. Copper getting to a new all-time high has faltered a bit back into the range. And this now we got lower highs. So there's a lower peak, lower low. Sure, another peak, but that peak might be higher than that one, but it's lower than that one. And now we're seeing a downtrend. So that doesn't augur well for copper. Looks like copper is going to fall away. Now, one point to make, just looking at that copper chart, is that it doesn't mean because the small and the mid caps are flying in the United States, so that's what's going to happen in Australia. Sure, there will always be pockets of opportunity in the small caps as individual stocks do certain things and they're going to fly. But typically, you're not going to be the first to find out about that. But with copper being weak, it is a bellwether for small to mid cap stocks, particularly in Australia, being mining and mineral stocks and resource stocks. So this is a little bit of a worry for the small cap sector in Australia. But let's see what happens. But I'm just saying that because small and mid cap are going to the US doesn't necessarily mean it's going to happen in Australia. So your opportunity is still with the stocks that make up the main part of the index. Oil is falling, so nothing to report there. Bitcoin has given a subjective because it's not mechanical, but certainly using this indicator, which works quite well on a shorter to medium term, an entry signal. So we've gone green there. There's its all-time high. Certainly a big run up here where it more than doubled and just slightly more than doubled. Consolidation, pretty typical to happen. You could draw a rectangle around that, which I could do for another session, but this now is giving an entry signal. So that is time to buy. Hasn't quite happened yet. We're maybe a day away from that happening on Ethereum. Looking at uranium, is reached a peak, bit of a retracement, going sideways, still in the channel, uptrend. So that trend is still well and truly intact. Iron ore going sideways, finding this long-term base over here where it's normal, if you like, it's normal bases, and every time it gets up to the 130, kind of falls all the way back down to the 90s, and then looks like it's forming another symmetrical triangle. Yeah, but certainly going sideways at the moment, finding its form, as is thermal coal as well. It looks like it's forming a new base there. Right, just to go back and reiterate to see if there's any questions. Whoops, I should go to chat. There are some questions. Right, Don is saying, when you updated the analysis on the S&P 500 chart, I recall that you said it was done on a semi-lock chart. However, the chart presented this morning looked like a linear chart. It shouldn't be. Let's just go back to S&P 500. I did change the 300 to 5,000. That might be short-term. It does say short-term log. Let's just go and see the log. Yeah, it actually is. Why have I got log there? Might not have saved the time that I did it. I'll have a look at that. Don, thanks very much. Eagle, thanks for picking that up. I will have a look at that and see how it affects the change. And I've even got the log over there as well. Anyway, that may have been in me. Anyway, I'll have a look at it. I may have had some finger trouble with that. Thanks for pointing that out. Right, so the theme is, what's the theme? Rotation. Really got large cap just stalling, some rotation happening, and small mid cap stocks starting to run, which means it brings in, from purely a price movement perspective, we look at breadth of market, we look at sentiment, and now we've been looking at those all the time. Now, if you like, the remaining story of the sentiment is that we've got small and mid caps. There's sufficient confidence in the market and positive sentiment in the market to go there, to go into the small and the mid caps and go and find those opportunities there. And that's exactly what we're seeing. It's only the beginning of it, which is what our charts and the analysis that I've got, that I showed you earlier, of the Ciroc, of the relative strength and the like, are showing that this is just starting. So now's the time to get in. Right, no, the questions, we'll leave it there. I should also tell you now that we're going to have a bit of a mix-up. I'm not going to be doing this particular format session. We've had a discussion internally, and we've had some suggestions from customers that we mix it up a bit. And I'm going to start bringing in alternate fortnights, looking at the public portfolios, analyzing them, looking at and making comments about individual trades, and talking about portfolio management. And using the public portfolios as a means to do that, and hopefully coming up with some training, both mindset and process training, and training that can actually add some value to our understanding of becoming effectively our own fund managers. So that's what I'll do in a couple of weeks' time, and look forward to that. Otherwise, I wish you all consistent and objective and peaceful active investing.